Section 1, life insurance policies. A big part of understanding the life insurance industry is understanding terminology. So we're going to go through a brief series of terms here that is very important for you to understand in understanding the life insurance industry. Insured is always the person whose life the policy will be issued on. It is the person on whose life the policy is actually written or actually issued on. The premium is the amount of money the policyholder must pay the insurance company to keep the policy in force. Cash value is what accumulates on permanent cash value life insurance policies, such as whole life, such as universal life, such as variable life. Portion of the premium paid goes to pay for the death benefit. A remaining portion of that premium is allowed to stay and remain inside that contract growing on a tax-deferred basis, and that becomes the policy owner's cash value. So the cash value is the policyholder's equity that is actually building inside a permanent cash value life insurance policy on a tax-deferred basis. The death benefit is the amount of money the beneficiary will receive when the insured dies. Please keep in mind the insured must die for the death benefit to be paid out to the named beneficiaries, and it will be paid out to the named beneficiaries federal income tax-free. They will not have to pay tax on it. They will receive it all federal income tax-free. Now, riders are things we can add to the policy for extra protection at an additional cost. It provides additional benefits or an additional cost that can be added to a policy, such as an accidental death benefit rider, a disability income rider, a waiver of premium rider, and so on and so on. We have one whole section where we will discuss riders a little bit later on. The beneficiary is the person who will actually receive the death benefit upon the insured's death. So again, the person, the beneficiary who is named, and it can be more than one person, a beneficiary or beneficiaries, plural, that are named on a life insurance policy are going to be the person or people that will be receiving the death benefit federal income tax-free upon the insured's death. Now, term insurance. We're going to discuss term insurance here. Term insurance is just pure protection insurance. It's also known as temporary protection insurance. Why? Because it covers a person only for a period of time, a term. That's where it gets its name. So it's known as pure or temporary protection insurance. It provides a death benefit only. No cash value builds up inside a term insurance policy. It is pure protection. The policy owner must pay the premium on time or before the end of the grace period. And if they do, then the death benefit will be paid out to the named beneficiary upon that insured's death. So it provides death benefit protection only, no cash value. The face amount, the death benefit, is payable only if death of the insured occurs during that term period, during that period of time that term insurance policy is in place. A person can choose how long they want that term to be on the term insurance policy they take out with you, the agent. Term periods can be 1 year, 5 year, 10 year, 15 year, 20 year, 30 year. Some companies even write a 40-year term. Or you could select term that will cover you all the way out to your age 65. We call that term limited at age 65. So the term, the period of time, person must choose when they take out the term insurance policy. The maximum amount of life insurance for the lowest initial outlay of premium. Yes, it is the cheapest form of insurance protection in the short term. It can easily be the most costly form of protection, however, in the long term. It does provide the maximum amount of life insurance for the lowest initial outlay of premium. Now, advantages and disadvantages of term. Advantages of term is that it is less expensive and it ensures insurability to offset debt, to offset mortgages, to provide death benefit protection for the many reasons a person could choose to insure their life. Disadvantages is that it provides coverage, but it is not permanent coverage. It only covers that for a period of time. So coverage is not permanent, and premiums do increase. And it does not build cash value because it is pure protection insurance. Now, there are different types of term insurance policies. There is level term, where you select a death benefit and pay the premium level for that period of time you have chosen, whether it's a 5-year level term, a 10-year level term, a 15-year level term, a 20-year level term, and so on and so on. You pay a level premium for a level death benefit, and it only provides you that death benefit for that term, that period of time that you had chosen. Another form of term is annual renewable term. Another name for that is yearly renewable term. You could tell from its name, the term is 1 year long. So the premium you pay is based on the age you are for that year. And if you choose to renew it because you have the option to renew the contract at the end of the year, then you will pay a higher premium the following year because you have had a birthday, you have aged, and your life expectancy has become 1 year shorter. So annual renewable term, the premium cost rises every single year, and your term term of protection is only 1 year long. So annual renewable term, yearly renewable term, two names for the same thing. Your term is only 1 year long. That's its name, annual renewable term. Decreasing term, another name for that is credit life. We use decreasing term whenever we use the term credit life, because decreasing term is usually used by banks, by mortgage companies, by finance companies, institutions that lend out money. And they use decreasing term insurance to protect that person's life that they have lent that money out to. So that if, God forbid, something happens to that person, that bank, that mortgage company, that credit union, that finance company is protected. They would get their money back from the insurance policy. So decreasing term always starts out at the amount of the loan, never higher than the amount of the loan. Always starts out at the amount of the loan and decreases down to zero over time. So as that person continues to pay off that mortgage or pay back that loan plus interest, the decreasing term insurance policy base amount is decreasing right along with that loan or mortgage being paid off. And it will eventually decrease down to zero over the length of the loan. Increasing term insurance is usually used as a rider to provide extra protection on a different policy. So increasing term riders are used on whole life insurance policies generally to increase the amount of protection. Usually the increasing term rider is tied to some other aspect of the policy. So you could have an increasing term rider on a whole life insurance policy that increases as the cash value inside that whole life policy increases. So if that person died, not only would the death benefit be paid out on the whole life policy, but so would an amount be paid out to the beneficiary federal income tax free that is equal to the accumulation of cash value inside that whole life insurance policy. You also could have an increasing term rider attached to the amount of premium that the person has paid into the contract. So as they continue living and paying the premium, they're paying more and more premium into the contract. The increasing term rider is increasing right along with the amount of premium being paid into that whole life contract. So again, if the insured dies, not only would the death benefit be paid out on the whole life insurance policy, but so would the amount of increasing term rider be paid out. That is, in this case, equal to the amount of premium the policy owner has paid in to the contract. So we use increasing term riders generally on whole life insurance policies, and it usually is tied to some other aspect of that whole life insurance policy, increasing premium, increasing cash value, and so on and so on. Now, level term, we said a person will choose a face amount for a level amount based on their need. In this example, it's $200,000. They also have chosen a 20-year level term policy issued at their age 25. So, the face amount they chose was $200,000. Took the policy out at age 25. Chose a 20-year level term policy, which means their death benefit will be level for the 20 years at $200,000. So if they died, the death benefit of $200,000 would be paid out to their named beneficiary federal income tax free. They will continue to pay a level premium for that $200,000 face term policy for that period of time of 20 years. Notice the red line is static. It is not increasing. They are paying the same premium level for that 20-year period of time that they have the protection in place of $200,000 level term insurance. Okay. The premium is level, made into the contract, level over 20 years. If the contract is to be renewed, the premium then increases at each renewal term. Their term is 20 years. So if they chose to renew it at the end of the 20 years for another 20 years, they would be 20 years older and they would definitely have to pay a higher premium for the next 20 years. Examples are a 5-year level term. It would be a level premium for 5 years. If they took out a 10-year level term, they'd be a level premium for 10 years. If they took out a 15-year level term, it'd be a level premium for 15 years. So 5-year level term, the premium increases at the end of the 5-year term. Now, decreasing term, we said, always starts out at the amount of the loan and decreases down to zero over time. So as that person pays back the loan to the financial institution or pays off the mortgage to the mortgage company, their face amount always starts out at the amount of the original mortgage or at the amount of the original loan and then decreases down to zero over that period of time as that person is paying off that loan or mortgage. So in this example, the person is choosing a $200,000 decreasing term insurance policy that decreases down to zero over a 20-year period of time. Again, they take out that policy at $200,000 at age 25, and it starts out at the amount of the loan or at the amount of the mortgage, which is $200,000 in this example. And as they continue to live and pay the very level premium, notice the red line is level. The premium remains level on decreasing term insurance, even though the death benefit is actually decreasing down to a lesser amount over that 20-year period of time. So it always starts out at the amount of the loan or at the amount of the mortgage and decreases down to zero, in this case, over a 20-year period of time. But note, when they pay off that loan or they pay off that mortgage in 20 years, there will be no death benefit protection either. And the premium they have paid over that past 20 years is remained level. So they are paying a consistently level premium for less and less protection on their life. Death benefit decreases down to zero over 20 years and generally is used, as we said, to secure a loan or a mortgage. Now, decreasing term, another name for it is credit life, because banks, lending institutions, financial companies, mortgage companies use it to protect themselves against the person dying that they have lent the money out to. So credit life protects the bank. It protects the lender, or not the lendee, not the person receiving the money. It protects the lender, the financial institution lending out the money. So it protects the bank, the lender, if the borrower dies. Life insurance cannot exceed the debt, cannot exceed the original face amount, or the original amount of the loan. It cannot supersede that. It starts out at the amount of the loan or at the amount of the beginning mortgage. So life insurance cannot exceed the debt. Decreasing term only with no cash value is what we use for credit life. Bank is the beneficiary in this case. The borrower is the insured, owner, and also the premium payer of the policy. If it is a group contract, then the bank is the owner. Insured pays the bank, and the bank then pays the insurance company. Now, many term policies are sold with the option to renew as part of the contract. Many term policies are also sold with the option to convert as part of the contract. Now, having these two features in a term insurance policy will cost the policy owner slightly more in terms of premium, but they are two very important features of a term insurance contract, because at the end of the term, the option to renew gives the policy owner the option to renew the coverage for an additional period of time without proving medical insurability. They will have to pay a higher premium because they are now renewing it for a longer period of time, and now they are older in doing so. So they will have to pay a higher premium, but at least having the option to renew as part of the term insurance policy will allow them to renew their coverage for a longer period of time without having to prove medical insurability. Now, that doesn't mean much if they stay healthy. That means a lot if they do not stay healthy. Having a heart attack, having a stroke, being diagnosed with cancer could be signs that that insurance company would not be willing to renew their coverage. But by having the option to renew in that contract, the policy owner has the ability to renew the policy at the end of the renewal period without providing any medical exam. They will renew. The new renewal term is based on their attained age that they have become. So they will renew it at a higher premium cost. Remember, always attained age is your actual age you are today. That's your actual age you have become as of today. So it will renew at your attained age, the age you have become today. So it will renew at a higher premium. Higher premium each time it renews because the person is older when they renew it. And it is always renewed after attained age. It is subject to maximum age limitations, such as age 70. Many insurance companies will not continue to renew policies beyond a certain age, and many companies set it at age 70. They could set it at other ages, but generally in the insurance industry, they set it at not willing to renew it again after age 70. Also, term insurance can have the option to convert in it, the convertibility option, we call it. So when the person has this option as part of their term policy, yes, they are paying a little bit more for the premium to have this option as part of their contract, but it also gives them the option to convert. Convert to what? Convert to some sort of permanent cash value, whole life insurance policy, for instance, or universal life, or variable life, or some other permanent cash value life insurance policy that has cash value in it. So the option to convert gives the policy owner the ability to change existing term policies from term to some sort of permanent cash value life insurance, such as whole life or such as universal life, again, without proving medical insurability. As long as you convert to the same face amount or to a lesser face amount, you will not have to prove evidence of insurability. If you ever choose to convert to a higher face amount, then you're asking the insurance company to take on more risk, and then you would have to prove medical insurability in that case. But having the option to convert to the same face amount or something less gives that person the option to convert to a permanent cash value life insurance policy that will then start to accrue cash value on a tax deferred basis inside it, and they are able to convert it to that policy without having to provide medical insurability. So they must maintain identical or lower death benefit to have that happen. The two conversion ages that they can convert a term policy to a whole life or some sort of permanent cash value policy is their attained age. That's their actual age. And most insurance companies will convert at the person's attained age or actual age. They simply exchange the term policy for a new permanent policy. The new policy premium is now based on their actual age they have attained and are today. Some insurance companies will allow a person to convert for term to whole life at their original age, the original age they were when they took out a contract. So if a company allows you to convert from term to whole life, let's say at your original age, the insurance company will then determine what permanent plan would have cost per year had the insured purchased that permanent insurance originally. And then what the insured needs to do is the insured needs to make a retroactive lump sum payment to the cash value in order to catch up the cash value as though the permanent plan had been in existence the entire time. So if a person wants to convert their term to a whole life policy at their original age, they've got to come up with a larger sum of money than just the premium. They've got to come up with the sum of money that would need to be placed in the contract now to make it what it would have been had it started out as a whole life policy originally. Whole life insurance. Now our discussion turns to whole life insurance. We're finished with our discussion on term. We will now discuss the features of whole life insurance. Whole life insurance is permanent cash value life insurance. A person takes out a whole life insurance policy. They lock in the premium cost at whatever age they are when they take out a whole life insurance policy. And that premium remains the same the rest of the life of the contract. So the younger you are and the healthier you are, when you take out whole life, the cheaper the premium. So in this example, this person is taking out a whole life insurance policy, again, $200,000 face amount, and the policy is going to be issued at their age 40. Now, if they take out a straight whole life policy, they will lock in the premium cost for a person, male or female, age 40. For the amount of face amount they choose, $200,000. And a straight whole life policy will require them then to not only lock in the premium cost, which will never increase, but they will have to make that premium payment all the way out on this whole life policy, all the way out until age 100, when the policy is set to mature or end out. And all that means is the cash value that has been growing consistently every year inside the contract will be on track to reach and equal the death benefit of $200,000 by that person's age 100. When that happens, the policy matures or endows. At that point, the cash value equals the amount of the face amount. The amount of cash value inside the contract equals the face amount, which is the $200,000. And at that point, there is no more need for insurance. So the insurance company, within days of that person turning their 100th birthday, will cancel the contract and mail a check back to the original policy owner. In this case, it will be called a living benefit because that policy owner has lived long enough to receive it as a living benefit. If they died anywhere along life's line, then the death benefit only of $200,000 will be paid out to the named beneficiary, federal income tax free. So, on a straight whole life policy, you lock in the premium cost to whatever age you are when you take out the policy. You must pay the premium all the way out to age 100. The policy premium will never increase. The face amount will never change. The face amount is locked in, the premium cost is locked in, and you, on a straight whole life policy as a policy owner, must continue to pay that premium all the way out to age 100. Now, there are other variations of whole life besides straight whole life. You could choose a limited pay whole life. A limited pay whole life means that you would like to choose to pay that premium, pay that policy up in a shorter period of time. So you could choose a 10-year limited pay, a 20-year limited pay, and over that period of time, or a life limited at age 65 limited pay, and over that period of time, you will pay in a higher premium, but you will have the policy paid up in that time frame, 10 years or 20 years, or you'll have it paid up by your age 65 if you choose a life limited at age 65 policy. So anytime we shorten the pay-in period that the premium is going to go into the contract, that will mean the premium cost will be much higher. So a 10-year limited pay premium will be much higher than a 20-year limited pay premium. And that will be much higher than a life limited at age 65 policy with a life limited at age 65 premium going in it. And the cheapest form of premium going into the contract is to choose a straight whole life policy where your premium is locked in and it is the lowest amount of premium that you are paying in over that period of time until you reach your 100th birthday. So, cheapest way to pay your premium on whole life is to select a straight whole life policy. If a person doesn't want to do that, however, and many people don't, they want it paid up at least by the time they are thinking about retiring, which would mean a life limited at age 65 policy. Many times people will have a substantial earned income now and want to pay up their whole life policy within a 10-year period of time. Or if they can't do that and can't afford the premium for that, many will choose a 20-year limited pay premium. In either of those cases, 10-year limited pay, 20-year limited pay, or life limited at age 65, the premium will be a higher cost than it would be if they strung their premium out over the whole straight life of the policy. Okay? So in whole life, we have cash value that will equal the death benefit at age 100. The premium will be locked in. This person is taking out a $200,000 face amount whole life policy issued at their age 40. So they lock in the premium cost for a 4-year-old. And that premium cost remains level all the way out to their 100th birthday, at which point the policy would end. Policy owner pays an annual level premium level for those 60 years of $200,000 worth of protection. Part of the premium that is paid into the whole life contract pays or the death benefit protection of the $200,000 in this example. And part of the premium then will go into the cash value and continue to build on a tax-deferred basis so that that policy owner could have access to that cash value anytime they wish. They just must borrow it out and be willing to pay an interest cost on the borrowing privilege. So cash value inside a whole life contract continues to build after approximately 2 or 3 years. Usually whole life does not show cash value in the first year. Too much cost is being incurred by the insurance company to get the policy issued and get it in place. So it usually does not show cash value in the first year. Many times to make a whole life policy competitive with other insurance companies' whole life, it will show some degree, although a very small amount of money, as cash value in the second year. If it does not show cash value in the first or the second year, then it must start to show cash value by the third year. Then the cash value continues to increase with every premium payment each and every year, and it continues to grow inside that contract on a tax-deferred basis. It grows and earns interest at a fixed interest rate. We sometimes call that an internal rate of return. And the cash value is always available to the policy owner via a loan option. You can borrow out up to 100% of your cash value anytime you wish. You just must be willing to pay interest on the ability to borrow it out on that lump. Or cash surrender, where you surrender the policy, and you're literally surrendering the policy back to the insurance company, telling them to go ahead and void out the contract. You have no need for the death benefit any longer in your life, and they will void it out and send you a check for any cash surrender value you are entitled to. When you surrender a policy, you will pay tax on all of the buildup that you have incurred in one single year. And that will have to be reported then as ordinary income on your tax return when you file your 1040 form by April 15th. Not available to beneficiaries in addition to the death benefit. No, the cash value is not paid out on a whole life policy in addition to the death benefit. The death benefit, the face amount of whole life, is the only thing that's going to be paid out to the beneficiary upon the insured's death, federal income tax free. The accumulated cash value inside that contract has gone to offset the cost of that insurance company having to pay out that death benefit upon the insured's death. So the insurance company will keep all the remaining cash value that is accumulated in that contract, but they are under contractual obligation to pay out the death benefit only on a whole life policy to the named beneficiaries. If a person wants the cash value to be paid out in addition to the death benefit, the face amount of the policy, then they must put an increasing term rider on the whole life policy that will increase as the cash value increases. Then if they have that rider in the whole life policy, when they die, not only will the death benefit be paid out to the beneficiary, but so would an amount equal to the cash value be paid out to the beneficiary from the increasing term rider placed on the whole life contract. So the only way a person can get the death benefit plus the cash value paid out to their beneficiary upon their death is to make certain they add the increasing term rider to their whole life contract when taking out the policy. Other forms of whole life besides straight life is continuous premium whole life. Also, other forms are, as I said, the limited pay whole life, whether it be 10-year limited pay, 20-year limited pay, or life limited at age 65. Predetermined life, the premium is predetermined, the death benefit is predetermined, the cash value is on track to reach the death benefit by that person's age 100 when the policy will be set to mature or end out. Now, cash value in whole life will equal the death benefit by the person's age 100. Cash value grows faster as more premium is paid in sooner. So if you pay in your premium only over 10 years or only over 20 years, your cash value is going to grow faster because your premium going in the contract is substantially more than a straight whole life policy. So premiums paid for a specific number of years of 10 or 20 or 30 years means it is a limited pay whole life policy. Premiums paid until the owner reaches a specific age, such as age 65, is known as a life limited at age 65 policy. And then there is such a thing called a single premium whole life policy. They aren't as popular as what they once were, but a person could take out a single premium whole life policy, pay all of the premium in one fell shot as an initial premium, and then they pay enough money into it initially to make that policy paid up as of that moment. So only one premium, and the policy is paid up when the insurance company receives that one initial premium. It's called single pay whole life. It is paid up with just one single payment. It is the most expensive initially, but the least expensive over the person's lifetime. Why? Because they are paying this large sum of money into the contract only once. So there's no administrative fees. There's no other kinds of fees attached to ongoing premium payments that are charged to the policy owner when people have to allocate their premium over a number of years to that contract. It's just going in initially when they take out the policy. So even though it's a much larger amount of cash a person would buy a policy for, initially it is more expensive, but over time it would be the least expensive way to buy your whole life insurance policy. Now, adjustable life, a different form of whole life. Adjustable life is just that, much more flexible than whole life. See, whole life is kind of a policy that is carved in stone. You choose the original face amount, it stays that face amount for the rest of the life of the contract. Based on your age, you lock in a premium cost, and that premium cost remains the same all the way out to your age 100 when the policy matures or not. So whole life is kind of carved in stone. It doesn't have flexibility. It is what it is. When you take out the policy, You lock in the face amount, you lock in the premium cost. But on adjustable life is much more flexible than whole life. It is a permanent cash value policy with all the characteristics of whole life, except it has an adjustment provision, which allows the policy owner to adjust the face amount based on their changing needs in their life. They might get married, they might have children, they might sell one house and buy a bigger house, have a more substantial mortgage to meet. So they have different reasons for increasing the amount of insurance on their life throughout their lifetime. So this adjustable life policy could allow them adjustment provisions inside the contract, which will allow that policy owner then to adjust that face amount higher based on changing needs that they incur in their lifetime. Within limits, the premium or face amount may be adjusted upward or downward. Increase the face amount or decrease the face amount. It is adjustable. It is more flexible. The increasing the death benefit almost always will require proof of insurability, however, to the insurance company. Remember this principle. Anytime you're asking the insurance company to take on more risk, they will ask you to provide them evidence of insurability. No insurance company will just be willing to take on more risk without you proving to them that you have remained or that you are very, very healthy. So increasing the death benefit almost always requires proof of insurability. The person on adjustable life can also alter the type of coverage. It can be converted. It can start out as term insurance and be converted to whole life once in the life of the contract. Or it could start out as a whole life contract and be converted to term insurance, but only once in the life of the contract. So a policy owner could alter the type of coverage from term to whole life once, or from whole life to term once in the life of the contract. It requires a flexible premium payment period. And the premium payment is higher than what is needed. Due to all this flexibility that is built into the contract, that cost is passed along to you, the policy owner. It provides a protection time frame for that period of years, whatever that person takes out that policy for. Now, flexibility. Universal life is the most flexible policy probably of all because it actually was developed in addition to adjustable life with a few more features added to it. It was designed back in the 70s and early 80s to offset a competitor's cry of buy term and invest the difference. So insurance industry came up with what they call a universal life insurance contract. They had the research and development teams develop this policy that would include a lot of flexibility, a lot of choices to be made by the policy owner. So universal life is a very flexible premium adjustable life policy. It is a combination really of an annual renewable term insurance policy that we have inserted a cash value account inside it. We call that a policy account. So if you could think of universal life as an annual renewable term policy, that's kind of a wrapper. And inside that annual renewable term policy, we insert a policy account. Now, it makes it a combination then really of annual renewable term or insurance that also has a cash value fund inside it, known as the policy account. It provides a death benefit, thereby the premium can be altered up or down depending on the changing needs of the person. So they could adjust their death benefit higher. They could also adjust their death benefit lower on a universal life contract. That is simple to do. All it is one phone call made to the insurance company. Now, if they increase the face amount, the person needs to be prepared to prove evidence of insurability. Because again, they're asking the insurance company to take on more risk. And anytime you're asking an insurance company to take on more risk, you're going to have to prove evidence of insurability. But the death benefit, thereby the premium, can be altered up or down depending on a person's changing needs. They could even overfund the contract, pay more than what the target premium is. The target premium is the amount of money they should be paying consistently into that policy account to make sure that as the cost of insurance rises, because every year they have a birthday, because it is annual renewable term, the cost of insurance will rise each and every year. But if they continually pay the target premium into the universal life contract, that's the amount of money they should consistently pay into the contract over time to make certain there is always enough policy account value inside that contract at the beginning of every month or whenever the insurance company drafts for the cost of insurance protection, and it usually is at the beginning of every month, there will be substantial money in the policy account to offset that cost of insurance plus the administrative charge. So a person can overfund the contract by paying larger amounts than the target premium, thereby lowering or eliminating the need for premium as long as cash value is present. This policy is so flexible they can even skip premium payments. But if you skip premium payments for too long, your policy account value may or may not be large enough to withstand the cost of insurance that is going to be drafted from that policy account, usually each and every month, to pay for the cost of the death benefit, plus the administrative charge. So you don't want to skip too many premium payments on universal life. Otherwise, they will send you one premium notice. It says you must pay us this amount of money by this date, and we need to have that money in our hands. Otherwise, the policy will implode and it will be no longer. So, best thing is to sell a universal life policy so that the policy owner knows and understands what the target premium is. The target premium is the amount of money the policy owner should pay into a universal life contract on a very consistent basis. That is the amount needed to keep that contract in force over the life of the contract. Okay? They could pay less. They could pay more. But if they pay less for too long, then they could see a day when they don't have enough money in the policy account to withstand the draft for the cost of insurance plus the administrative charge. Now, universal life is a permanent cash value life insurance policy. So you have cash value to withdraw, if you wish, as a policy owner. You also have a borrowing privilege on UL. On UL, you can borrow out up to 75 to 80% of the policy's account value. Why is it only 75 to 80% when whole life you could borrow out up to 100% of your cash value? Because the cost of insurance on whole life never changes. But the cost of insurance on universal life changes every year as the person has a birthday, because it is annual renewable term insurance that provides the death benefit protection on universal life. So the cost of insurance on a universal life contract is going to increase each and every year as the person continues to age and celebrate their birthday. So on universal life, a person can only borrow out up to 75 to 80% of the policy's account value. That means they have to leave the remaining 25% in there, because at the beginning of every month, when the policy is, the insurance company is drafting from the policy the amount of cost of the death benefit protection, there has to be enough money in the policy account to withstand that, plus the administrative charge. But a person has not only a borrowing privilege on universal life, they also have a withdrawal privilege. Now, borrowing, when you say the word borrow to an insurance company, you are insinuating that you're borrowing money out of your cash value, willing to pay an interest rate on it, and you have the intention of paying it back. Borrowing means a privilege you have as a policy owner to borrow out of your cash value, but your intention is to pay the loan back plus interest. Now, on whole life, you only have the borrowing privilege. On universal life, you have not only the borrowing privilege, but also a withdrawal privilege. And when you say the word withdrawal to an insurance company, you are insinuating to the insurance company, I wish to withdraw some of my cash value, and I have no intention of paying it back. So when you make a withdrawal on your universal life policy, the insurance company will treat that as a withdrawal, and they will tax you on that withdrawal amount that you have withdrawn from the policy account. So cash value, you have the borrowing privilege to borrow it out and pay interest on it up to 75 to 80% of the cash value. You also have a withdrawal privilege on universal life, which allows you to withdraw the money. It is a permanent withdrawal. It is treated as a permanent withdrawal, and you will be taxed on it at the end of the year. You will receive a 1099 INS form for the insurance company, and you will have to report that then as ordinary inbound on your 1040 form and pay tax on the amount you withdrew from the contract. Partial cash value withdrawals are allowed on UL, but it does create a taxable event for the policy owner in doing so. Now, universal life is really a transparent policy. It's an unbundled policy. We literally took a whole life policy, unbundled it to create a universal life contract. So we call it an unbundled life insurance policy. It has an unbundled premium. The owner receives an annual statement at the end of the year indicating a breakdown of premiums that have gone into the contract, the amount of death benefit on the contract, mortality charges taken that have had to be allocated toward the cost of the death benefit, any other expenses like administrative charges and so on. And also it will show the policy owner's cash value on that annual statement. Interest rate, they will be charged. They will actually earn, a universal life contract will earn at least a guaranteed minimum rate, and that is usually stipulated right inside the contract of usually 4%. But insurance company will credit you an interest rate equal to the amount of interest they are willing to pay you for a 12-month period of time. And that interest rate changes each and every year based on what interest rates are doing out in the marketplace. So as interest rates rise, you could find yourself earning a higher interest rate on your universal life contract. If interest rates stabilize, it would probably renew the same the following year. And if interest rates decrease, you could also see yourself earning a lesser interest rate than the previous year, because the interest rate on universal life is determined by the insurance company once a year. And your new interest rate usually takes effect on your contract anniversary date. But there is a guaranteed minimum rate written right in the contract that you are guaranteed at least earning that minimum interest rate on your cash value. And that is also determined by the insurance company and written right in the contract. Your interest rate may be higher due to investments and short-term investments that the insurance company invests your premium dollars in, such as money market rates, such as, short-term bond funds, things like that. The higher rate affects the cash value buildup. So obviously the higher rate of interest you're earning on your cash value inside your universal life contract, the more money you're making. The higher rate affects the cash value buildup, but not your premium nor your death benefit. Now, universal life, one of the unique features of it is that it has two different death benefits that the policy owner can choose when taking out the policy, and also have the ability to change in the future if they wish to. The two death benefits offered on a universal life contract, the first one is known as option A. That means that if the person chooses option A, you as the agent would check off the box for option A on the application for the universal life contract. And that means when the insured dies, the death benefit only, the base amount of the policy only, will be paid out to the named beneficiary federal income tax rate. However, if the person says, well, I want what about my accumulated cash value inside the policy account, I would like that in addition to the death benefit paid out to my named beneficiary, okay? Then you have the option to choose option B, which allows not only the level death benefit to be paid out to your beneficiary upon your death if you're the insured, but also your accumulated cash value that has been accumulating inside the contract. Option B allows the policy owner to choose to have the level death benefit paid out to their beneficiary upon their death, in addition to the cash value that has accumulated inside the contract. The death benefit is not guaranteed in a universal life contract due to the ability of the owner to alter payments of premiums going into the policy. Don't forget, universal life is a flexible premium cash value life insurance policy. So the premiums going in are determined by the policy owner. So if they skip premium payments or pay less than the target premium, or maybe go for a series of months but they don't pay the premium, that can affect not only the policy cash value, but also the death benefit. Now, joint life and last survivor insurance. Joint life is a whole life insurance policy that is actually issued on two people's lives. It's one policy issued on two people's lives that pays the death benefit out to the named beneficiary when the first party dies. So it is known as joint life, or a first to die policy. It covers two or more persons under one contract of insurance. So they factor together, let's say the male, what his age is, what his life expectancy is. If it's a married double, what her age is, what her life expectancy is, and what the cost of that would be. And they factor together that premium cost to develop one policy with one face amount issued on both of their lives. So it is a way of possibly this couple taking out a more substantial amount of life insurance in their life with a less premium cost, because we're going to factor together the premium cost of each of their lives based on each of their life expectancies. So it's a one policy that will cover two people's lives that pays when the first one dies. I refer to that as 1-2-1. One policy written on two people's lives that pays when the first party dies. So it is a joint life policy. It covers two or more persons under just one contract of insurance. And when the first insured dies, or even if the spouse dies, the death benefit is paid to the named beneficiary. At that point, the policy pays out the death benefit to the named beneficiary, and the policy ends upon the first insured's death. So that is known as joint life. Then we have another type of policy known as a joint and last survivor policy. This is what we call many times a second to die policy or a last to die policy. Here again, this is one policy written on two people's lives that when the first party dies, nothing happens. The contract stays in place. The premium must still be paid on the policy. A policy will not pay out the death benefit until the second party dies. The last survivor dies. So it is known as a survivorship policy, a second or last to die policy. Again, it is generally a whole life policy written on two people's lives that covers two or more persons under one contract. No benefit is payable upon the death of the first person. The contract continues, premium continues to be paid until the last person dies. Then the death benefit is payable after that last person dies. It offers premiums that are quite low compared with those that would be charged for separate policies. These policies are well suited and well situated to meet the need for cash to cover estate taxation. If you know anything about federal estate taxation comes due 9 months to the day after the second party dies in a married couple situation that has accumulated an overall estate as of January 1st, 2023 of $12.45 million. So anything in their estate valued higher than the $12.45 million, they will be taxed at 50 to 55% of that amount of money in excess of that $12.45 million, 9 months to the day after that second person dies in that married couple situation where their overall estate is valued in excess of the $12.45 million. So one way to pay off those federal estate taxation and handle that federal estate taxation problem that has to come due 9 months exactly to the day in total and has to be paid in total to the federal government by that period of time. One of the ways to offset that cost, and the cheapest way to offset that cost, is through the use of a survivorship policy. Okay? So in this case, the married couple cannot own the policy. They would have to establish an irrevocable trust through their attorney. The irrevocable trust would need to buy the policy, be the owner of it, pay the premium on it, be the beneficiary of it. So when the first person dies, nothing happens. Premium still needs to continue to be paid on this policy. But when the second party dies, that's when the death certificate would be submitted to the insurance company, and the death benefit on this policy would be paid back to the irrevocable trust. The trustee of the irrevocable trust would then pay the federal estate taxation bill that comes due to the federal government within the 9 months following the death of that second party, and the proceeds of this policy would be used to pay all of that federal estate taxation bill to the federal government, thereby allowing the estate that this married couple has accumulated over their working lifetime to be able to pass on to their heirs, their children, their grandchildren, whomever they would like those assets in their estate to pass on to. It would pass on to them in total. It's a way of allowing owners who have a sizable estate not to allow the federal government to whittle away at that estate based on federal estate taxation that comes due 9 months to the day after the second party dies, but uses this policy to pay off that federal estate taxation bill so that the overall estate can pass on to their heirs in total. It is the cheapest way to pay federal estate taxation and take care of that federal estate taxation problem. So the joint life survivor last to die policy covers two or more persons under one contract. No benefit is payable upon the death of the first person. Death benefit is payable after the last person dies. That's why we call it a last to die policy. It offers premiums that are quite low compared with those that would be charged for separate policies. This policy is well situated to meet the need for cash to cover estate planning taxation. We call it the federal estate taxation situation. And it provides face amounts that usually exceed far above $1 million contracts. If you're dealing with the estate planning market, you are generally using this policy to attack that federal estate taxation problem. And many times these policies' face amounts are in the millions and millions, maybe even the hundreds of millions of dollars. Now, jumping juvenile or juvenile policies. First of all, the juvenile policy is taken out by the parent or legal guardian on the juvenile's life, the juvenile being a minor child. So juvenile life insurance is a policy placed on the life of the child where the child is the insured, the applicant and policy owner is actually the parent or legal guardian of that child. So you got the applicant being the parent or legal guardian, taking out a policy on a juvenile's life, and the juvenile child is the insured on the policy. So the parent, once the policy gets issued, the parent or legal guardian would then own a policy on the juvenile's life. Juvenile life insurance is a policy placed on the life of the child. The parent is the owner, and the child is the insured. Now, if we talk about a jumping juvenile policy, a juvenile policy is taken out for one face amount and it remains at that face amount throughout the life of the contract. That's a juvenile insurance policy. But when we talk about a jumping juvenile policy, that policy again is taken out by the parent or legal guardian on the child's life for a certain face amount upon them taking out the policy, but that face amount will jump 5 times that original face amount when that child reaches either their 18th or 21st birthday with no premium increases. So a jumping juvenile policy is a wonderful policy for a parent or legal guardian to take on a juvenile's life, on their child's life. It will provide a set death benefit when they take out the policy. And if it is a jumping juvenile policy, that face amount of the policy will jump 5 times the original face amount when that child reaches either their 18th or 21st birthday as stipulated in the contract, with no increase in premium cost. So right about the time the child is becoming an adult, out of school, out of college, maybe purchasing their first home, maybe getting established in the workforce, maybe even getting married and starting their own family, their face amount of their jumping juvenile policy will jump 5 times the original face amount. Now, it will only do it once. It will only jump 5 times the original face amount once when that child reaches either their 18th or 21st birthday. But then when they reach 18 or 21, they've got a more substantial amount of life insurance now issued on their life, which makes them further protected for, things that are going to happen in their adult life in the future. Variable life is another form of life insurance. Variable life has been around really since the 60s, late 50s, early 60s is when these policies first started being created. Variable life has 2 different aspects. We have a variable whole life insurance policy that operates a certain way, and then we also have a variable universal life policy that operates a certain way. Let's take variable whole life first. Variable whole life has some of the attributes of whole life, like a level premium being paid into the contract, but it also has some of the attributes of variable life, which gives the policy owner the option to invest their premium dollars in different sub-accounts that make up the separate account. So variable whole life has all the characteristics of ordinary whole life, like a level premium going in it, with one distinct difference. The cash value is directed into the separate account or different sub-accounts that make up that separate account, such as an aggressive stock account, a common stock account, a balanced account, a bond fund, a money market account, a fixed account, and usually several managed money accounts are also offered as investment options inside variable life insurance. So anytime a policy owner owns a variable life insurance contract, the premiums they pay into that contract go in the separate account, separate from the insurance company's general account that receives premium dollars from term, from whole life, from universal life, both fixed and indexed annuities. All those premium dollars go in the general account of the insurance company and literally become an asset of that insurance company. And then those money managers of that insurance company invest those dollars a certain way to get a certain rate of return. On variable life insurance, the policy owner pays the premium to the life insurance company, and it must go and be kept separate from the general account money. So dollars for a variable life contract go in the separate account. Separate account is an account an insurance company has to maintain if they sell variable products. The dollars paid in for variable life insurance has to go in the separate account, and those premium dollars have to be kept separate from general account money. those dollars can never be commingled with general account money, because dollars going in in that variable life insurance contract must go in the separate account, because the owner of the variable life insurance contract is going to instruct the insurance company how to invest those premium dollars in that separate account in those different sub-accounts that they wish their premium dollars invested. And I just mentioned several of those sub-accounts to you. Common stock account, aggressive stock account, balanced fund, bond fund, money market fixed account, and also several managed money accounts usually are offered as well. So the policy owner is going to direct how they want their premium dollars invested in those variable life insurance contracts. Okay, so that those premium dollars on variable life can never be commingled with premium dollars for any other type of policy. So variable whole life, again, has the characteristics of ordinary whole life, with one distinct difference, that the cash value is going to be directed into that separate account made up of those different sub-accounts. The cash value is invested in stocks and bonds and other investment vehicles offered through that separate account. The separate account is regulated as a mutual fund by the Securities and Exchange Commission, according to the Investment Company Act of 1940. So you need to become not only a licensed life and health insurance agent, but also you need to take this license once you get it issued to you at the state level and appoint it with an insurance company. And when the proper time arises, you will say to the insurance company, I wish to begin to study the materials for my Series 6 or my Series 7 federal license. And once you pass either the Series 6 or Series 7 test, then you will become eligible to be able to sell variable products. Anything with the word variable in it, see the V in the word variable, you think automatically SEC is involved, because the Securities and Exchange Commission is a division of our federal government that regulates investment products. And variable life is definitely considered an investment product, a securities product. So the Securities and Exchange Commission regulates these securities products. So you have to be duly licensed, both a life license issued to you at the state level, and then you must appoint it and at the proper time study the materials and get your Series 6 or Series 7 license issued to you. A Series 6 license will allow you to sell variable life, variable universal life, variable annuities, and mutual funds only. Just those four investment products. If you choose to be able to sell individual stocks, individual bonds, real estate investment trusts, options, then you must get a Series 7 license. That's the big, broad, general license that a person gets issued when they want to sell those different types of investment vehicles. But you got to get one of those federal licenses, either the Series 6 or Series 7, in addition to your state life insurance license, in order to be able to sell variable products. So, variable products have usually greater cash value, growth potential. Key word in that sentence, potential. Is there anything guaranteed in a variable life contract? Nothing. Okay? Because performance of your money inside that separate account is going to be tied to stock market performance. So as the stock market increases, the value in your variable life contract will increase. If the stock market takes a downturn, then the value of your separate account inside your different sub-accounts making up that separate account inside your contract will have a diminished cash value. So it gives the potential, the opportunity, if you will, for the investor, the policy owner, to invest their money in such a way to have the opportunity for greater growth. But there is no guarantee on variable products. No guarantee regarding cash value at all. It provides greater potential for you to have greater amounts of cash value growing inside your contract. But for that greater potential of having your cash value grow to higher amounts, you also assume greater risk. So greater potential risk on these accounts as well. Cash value death benefit change daily based on the investment performance of your account value. And annual premiums are fixed on variable whole life. One of the attributes of variable whole life is that it has a fixed premium going in it. Remember I said it has some of the attributes of whole life and some of the attributes of variable life. So on variable whole life, it has some of the attributes of whole life, which is a fixed premium. And also some of the attributes of variable life, which gives the opportunity to the policy owner to invest their premium dollars in such a way that it could outpace inflation, okay? Give them better rates of return than what inflation could be eroding away at. You remember, it's only an opportunity. It's only an opportunity to have that kind of growth, no guarantee. So annual premiums of variable whole life are fixed, and it provides a guaranteed minimum death benefit. Life insurance, you must have a life insurance license issued to you by your state, and you must secure either a Series 6 or Series 7 federal license issued to you by FINRA, which stands for Financial Industry Regulatory Authority. Securities license is going to be required in addition to your state life insurance license to be able to sell anything with the word variable in it. Remember also, there is such a thing as a variable universal life policy. Now, it has some of the attributes of universal life, all the flexibility of premium going in it. That's one of the attributes of the universal life portion of the contract, but it also has investment options that the policy owner can choose to have their premium dollars invested in. So variable universal life is really a combination of universal life and variable life together in one policy. It has some of the attributes of universal life. It has also some of the attributes of variable life. Variable universal life is a universal life policy with the ability for the policy owner to invest in stocks and bonds and other different sub-accounts offered through that variable universal life contract. It is known as the most flexible of all life insurance policies. Flexible in increasing or decreasing the death benefit. Flexible in premium going in the contract. And also flexible in your investment options. You can choose to have those premium dollars paid in and invested in. Okay, our first activity, we're going to match up each description to the appropriate characteristic. So, our first description, our first characteristic is joint life. Joint life, we would match that up to the fact that it involves insuring more than one person's life. It involves more than one insured. Insured being the person whose life the policy gets issued on. So, joint life is one contract being issued that covers two or more people's lives. Decreasing term insurance, we're going to match that up with that involving more, decreasing term insurance with being known as credit life, or decreasing term insurance is going to, again, start out at the amount of the loan used by a lending institution to cover them in lending out the money, and will decrease down to zero over time. So decreasing term insurance, another name for it, is credit life, and it is definitely going to be involved when a lending situation is taking place. Variable life is going to have different investment options involved in it to allow the policy owner to invest their premium dollars in those different sub-accounts, giving them the potential for possibly greater growth on their cash value. So variable life is always affiliated with stocks and bonds and other various type of accounts. Universal life is going to be involved with flexibility. It provides flexibility to the policy owner in terms of death benefit and also premium being paid into the contract. And a non-adult is going to always be known as a juvenile. Juvenile being a person who is not of legal age to own their own life insurance policy.